Okay, so let's take a look at an examples, a list where we can analyze how each transaction might affect our accounting equation, how it will be reflected in our accounting equation. So I'll write here on top the same accounting equation that we saw earlier. Assets equals liabilities plus equity. Yeah, and so let's see what happens here. Now here we have received cash investment um, from shareholders to start business in exchange for ordinary shares. Now, okay, so we receive cash. Cash is classified as an asset. It means that receiving cash is going to mean increase in cash in the asset section. Now, this side of the equation is affected. We have increase in assets. So we need to look into what's going to happen on the right side of our accounting equation, either liability or the equity. And in this specific case, we have a direct effect from shareholders. We have an investment from shareholders. It means that we have an increase in capital, increase in equity through capital or investment. So that's basically the very first one. So the first one is solved. We have increase in cash, increase in capital. Both sides of our accounting equation are balanced. There is no effect on the liabilities. We're done with the first transaction. Moving on to the second transaction. Here we have paid monthly rent. Now paying means deduction, decrease in cash minus asset. We have decrease in assets. And the rent, and we already know from the elements of financial statements that any asset that we use technically becomes an expense. So in this case, this is an expense. And if you remember from the expanded accounting equation, any increase in expense is going to decrease our equity. So in fact, this one is going to decrease our equity through increase in expenses. So we have two sides have decreased, cash has decreased, equity has decreased. So we're good. Moving on to the third one, purchased equipment. Again, equipment is an asset, and on account means on credit. We didn't pay for it. We bought an equipment. And how do we classify equipment? The equipment is classified as asset. Let me actually color coded it so that you do not get confused. So this is our assets, so plus in assets, so equipment has increased. But we have an increase, so we bought one asset, but we didn't pay for it yet. If we didn't pay for it, it means that we have created a liability. We have created a payables account. We've increased our liability. So both sides of our accounting equation has exactly the same effect from the same transaction. So we have assets increased, liabilities have also increased. Moving on to the next transaction. Here we have number 4. Billed customers for services performed. So we have billed our customers, and sending a bill implies that the service has been performed. So we have shown the service is performed, but we did not receive any payment. Not receiving payment doesn't mean that we don't have an increase in cash. It means that somebody owes us money. It means increase in not cash, because we didn't receive it, but assets in the form of accounts receivables. Receivables has increased, but we have shown service. If we show a service, we made a certain sale. Sale means revenue, and we have increase in revenue. That means increase in equity. So we have an effect, a positive effect on equity in this case. The fifth transaction, paid dividends. Now payment implies paying cash, and dividends, we already know, is part of the equity, and that's going to be affected as well. So payment means there is an outflow of cash minus cash on the left side of the accounting equation. And we have paid dividends, again, returning to the expanded accounting equation. increase in dividends means decrease in equity. So there is a decrease through increase of dividends. So dividends increase means decrease in equity. Minus here, minus there, we're fine. In the sixth transaction, we receive cash. Receiving cash means inflow of cash. So immediately we can say it's increase in cash. From customers billed in transaction number 4. When we build our customers, we have created this fourth one, we created an accounts receivable. Now in the sixth transaction, we are getting paid. It means that whoever owed us the money doesn't owe us anymore. So we have to show that decrease in accounts receivables. So this is the first in the line of our transactions. This is the first when only one side of accounting equation is affected. We have increase in cash, decrease in accounts receivable, means we have replaced one asset with another one. And so this is basically, there's no effect on the right side of the equation, and that's basically the end of the transaction here. In the seventh transaction, we have incurred advertising expense on account. Now, incurrence of advertising expense means increase of expense. Again, increase in expense means decrease in equity. On account means we have created a liability. So we have used advertising, but we didn't pay for it. If we didn't pay for it, it means that we have created a liability. We have incurred advertising expense on account. On account, which means we've created a liability, we have increase in accounts or just payables. Accounts payable or payables. Payables has increased. So there is an increase in the same right side. So increase here, decrease here, cancels each other out. So there is no effect on the assets. So everything is fine. There's a balance, correct balance in these transactions. Moving to the transaction 8, we have purchased additional equipment for cash. Buying equipment, and equipment again is assets, and we bought it for cash. We have only one side of accounting equation affected, means that we replaced one asset, we paid cash, we received equipment in the same amount. So one is replaced by the other, the right side of the accounting equation stays the same. In the 9th transaction, we receive cash. Cash is an asset, we received cash from customers when services was performed or were performed. So we've performed the service, and performing the service again, what does it do? It increases our revenue. And increase in the revenue means increase in the equity. And we received the cash right away. So the cash is increased. Both sides of the accounting equation have increased in the same way. Liabilities are unaffected. So we're basically done with the 9th transaction. In the 10th transaction, here's what we have. We paid for advertising expense. So from transaction number 7. So in the transaction number 7, we've already recognized advertising expense. We don't need to recognize it anymore. It's already there. So what happened is that we paid money, and paying money means outflow of cash. So there is a deduction or reduction in cash. Cash is minus. And what happened? So in the transaction 7, right here, we have incurred expense and we didn't pay for it. We've created an accounts payable. Here it is. We've created an accounts payable. And in the transaction 10, we decrease. So liability that we owe to somebody is settled. So we need to decrease the payables. Payables has decreased, cash has decreased, both sides of the transactions are affected, and we're done with the accounting equation.